Eric Muathe at Muathe.com with a one-on-one mentorship coaching video, and we are going to be taking a look and reviewing your recent purchase of SQQQ, and your purchase is somewhere here at about $24. Stock is trading at about 22.82, which roughly represents about a 4.9% loss. And just to remind you here, it's always good to keep the numbers at a safe range. You don't want to go anywhere more than 8%. And I'll send you a link as to why the mathematics go against you when you are more than 8% below your purchase level. So that's what we're going to be reviewing, your recent purchase of SQQQ. And just around $24 is where you got in a couple of days ago. And I am using right now the 6 months daily chart, and I'm showing you this 6 months daily chart for a reason. And one of the reasons is that most people will tend to look at the daily when making buy or sell decisions, and sometimes I believe most people look at either the 1 year daily, so most people go with the 1 year daily view, or actually the 6 months daily view. So that's why I'm showing you the smaller range, which is the 6 months daily, because this is the view and this is what normally somebody should be looking at if they don't consider other time frames. And so let's go and take a look at the purchase, and I'm going to begin with what I might consider a fundamental error, and I'll show you what it is. All right, let's go here, take a look first and foremost at the NASDAQ comp. So this is about 5 years worth of data on the NASDAQ, and you can see here that by going long the SQQ, obviously it's 3 times short the triple Qs. So it's 3 times short the triple Qs. So that's very simple to explain. And so you are betting that this is gonna drop while the SQQ gains in value, obviously. But now there's a fundamental error, and I would like to get into that. Number one, it's very simple. You see here since mid 2013, so somewhere around here, let's call it about May, June of 2013, the NASDAQ moved above 69.10. Now, generally speaking, whenever an instrument is trading above this value, you are not supposed to short the instrument. So yes, we see that there are periods where there was a couple of weeks of drop, like here or even here as an example. And we're not going to go into the details as to whether this was a good time to short or whether this was a good time to short. But what we're talking about, yes, even though the market generally has been up the last 2 years or so, and it's been trading above 69.1 over the last 2 years, we see that mostly it has been trending higher, obviously, and anybody who's been looking for short ideas in this trade has been, for the most part, frustrated. It's only this 2 month period here that I can see what I would call a reasonable drop. So since 2013, and now we are going to the 2 years staying above 69.1, you can see that this has been a very tough market to short. And something else, right now we are looking at the monthly for the NASDAQ, which is breaking out. Now rule number one, or at least one of the many rules, it's not rule number one, but it's one of the rules, is whenever you are looking for a short candidate, you are best off avoiding stocks that are breaking out. So we see that the NASDAQ here is breaking out on the monthly above the previous monthly closing high. So to me, the fundamental error is to short an instrument that is very strong. So the error here in my thinking is you are better off playing an instrument that is strong and playing it towards the trend, as opposed to doing the difficult job. And yes, at some point it's gonna correct. We all know that. What we don't know is when. It could be today, it could be tomorrow, it could be 2 months from today, it could be 2 years from today. It's very hard to predict where a market is going to pick. But we can at least use the technical indicators to tell us that a market is strong, and here we see a strong market. So I think on that position, without even knowing what tomorrow brings, and without even knowing how the market is going to trade the next week, the next month, the fundamental error here, in my opinion, is to go short an instrument that is trading and continues to hold above 69.1, even though at some point it's gonna correct. But to me, that's the fundamental flaw in that purchase of SQQQ, because you are going against the major natural trend, which is for this instrument to continue moving higher. Let's take a look at another chart here. And again, this is a close-up view for the NASDAQ. This is a 3 years monthly view. And again, just to show you, since July of 2013, which represents this entry here, so somewhere here, which again happened to be, so let me clear that. You can see that here there was a breakout, and that's the risk whenever you go short an instrument that is breaking out. So anybody who was shorting the NASDAQ here because it was making new highs was really fighting the trend, because the trend was breaking out, the market was testing new highs, and you can see that the risk is that over time it continues moving higher. And we know it was a risky trade because here's the RSI, and as of right now, even the RSI continues to point upwards. So we have to assume that the market is telling us that its intention is to go up and not down. We take a look at the NASDAQ, and I want to show you this period here between 95 and 2000. So we all recognize this as being one of the greatest bull markets, which was the tech bubble bust. And you can see the accelerated move towards the end of the 90s and into early part of 2000. Generally speaking, the market stayed, for the most part, trading above 69.1. So that's a fact. So during this exciting period for anybody who was long, and this obviously must have been a very difficult period for anybody who was trying to time the end of the market in this period. This was a very tough period, but all they had to do is just use the RSI on the monthly to avoid this pain. So this painful period here for any short idea could have been avoided if you would have respected and understood the power of markets that are generally staying above 69.1. Now conversely, we take a look at the most recent bear market, which was the 2007-2008, early 2009 bear market, which was this period here. You can see that the market was, if we take the generic view, off the highs. Here, the market had gone above 69.1 and failed. And one thing I would like to point out, even though we can cover this on another video, is this move above 69.1 here in late 2007 was something similar to, so let me draw that. So it was uniform activity. So this is 69.1. So let me just explain that. So 69.1, and the market came and hit that once, came down, had an inverted V-type formation. So we can say that this period here was actually showing rejection at 69.1, uniform activity above 69.1 and back below it. That was confirmation because of this uniform activity here. We call that rejection. And so that was already telling us that the market had failed to hold above 69.1. So even using that idea that the market was not trading above 69.1 could have been at least telling you that, okay, now I can start looking for short ideas. Now there's more into this. Of course, you have to look at the weeklies, the dailies, and all that stuff. I get that. And now this is oversimplification, because what I'm talking about here is a fundamental flaw in the SQQQ purchase, and I'll get to that momentarily. Again, we see here that recently we've been holding above 69.1, and if that's the case, then that suggests that this is a strong market. We absolutely do not short this market until we see the market move back below 69.1. Yes, we are not going to get the high with that strategy, but we are going to wait for the forces to turn down. And once the forces turn down, that's when we can look for opportunities to short. So I would say, if you take a look at before we go that, let's take a look at the daily chart for the Dow for today, because this is relevant. And I want to show you why, because we can see in the current market, the Dow is holding up the 50 level or the 50-day moving average. So your purchase from a few days ago, we can see that the Dow has failed to move below the 50-day moving average, generically saying that the market is holding support. We don't know about tomorrow, the next week, the next month, but for now we can say the market has come here, it's tested the 50-day moving average, it's holding. Now, because the market is doing this on its own, we have to assume it means something for now. Also, there is a trend line. If you draw the lows like that, you can draw them this way, connecting the daily closing lows, or you can draw it connecting the intraday lows like that. Either way, you can see the market has yet to break these trend lines. So there's another reason to say and argue why the market right now looks okay. And if the market is okay, then shorting the market itself is not the best idea. Also, I've been talking about this to subscribers, and also I believe on the weekend analysis video, is there's a line connecting recent lows like that. And over the last 2 days or so, as you went short the QQ, as you went short the triple Qs and long the SQQQ, the market actually found support here. So unless and until the market can break down below that line, you have to assume that the support we saw about 2 days ago was good enough to continue moving the market higher here. And at some point we also discuss what it means for the market holding the 50 level. But for now, all we have to do is to simplify it, is the market is holding on this line. And until it breaks this line, this market is poised to go higher. Also today, we saw that the market was momentarily trading below 50, suggesting a big down day. But the market did not close below 50. It recovered above the 50 RSI level, suggesting that even intraday the market found support, and the failure to close below 50 suggests to me that the market was strong enough intraday to correct that, suggesting that generally speaking we are looking at a market that is finding support on this line again, indicating that more than likely the failure to hold and stay below 50 on the daily RSI suggests that we are going to bounce in the coming day or so, which might put pressure on your holding there, which is the SQQQ. So let's move on here and take a look at this instrument. So now this is the instrument you own, and we see here that the risk, and it's a problem, is the fundamental error is holding an instrument that is trading below 30.90. Keep in mind, 30.90 is just the exact opposite of 69.1. If you had been aware of this requirement that an instrument that needs to go up at the very least needs to be trading above 30.90, or another way of looking at this is that any instrument that is trading below 30.90 is extremely bearish. If you know this and if you rely on this, this would have kept you away from this instrument, going back to the price level somewhere here, even as high as 500. This is a split adjusted, I believe. Right now the stock is trading at 22. So all the way from 500 in 2011, maybe even before that, and now trading in the 20s, lower 20s, over the last 3-4 years, all this period has been taking place with the stock trading with its monthly RSI below 30.90. So what I'm trying to say here is very simple. The fundamental error here is to own a stock that is super bearish. And this suggests that the likelihood of lower prices is even still existent in the stock. It is only until the stock manages to finally move above 30.90, it needs to move above 30.90 first and foremost needs to move about this if it can correct the fundamental error. So this is a risk. More than likely, the trade, in my opinion, will not work. Just based on that simple analysis. And again, it could have kept you away from this instrument throughout all this pain. Throughout all this pain. Anybody who was buying the stock, this instrument, the last couple of years, thinking that they were buying the stock at the lows, would see their prices deteriorate because of this fundamental observation. So to me, that trade is probably a bad idea, more than likely will not work. Again, take a look at the weekly, and we can see here, this is just a straight slope lower. Yes, it has periods of slight bounces that somebody can say that they can have a swing trade, but this is difficult and it's very short-lived. Eventually, you tend to roll over and make fresh lows. And right here, we are sitting at almost close to fresh lows, and it would not surprise me that if we continue down and make fresh lows. If we take a look at the daily, and I was telling you that based on the daily, that there's a reason why this could be support based on this line here. And this makes a lot of sense. So if this can hold, that it is very likely on a day-to-day basis that you can get a swing trade for a couple of days to the upside, maybe even good enough to bring you back to your close to $24 entry. So that's very likely if this line holds. The problem is because of the bearish nature of the monthly chart, it is not unlikely for this to break. And that's the risk. So let's keep it simple. You can continue owning the instrument knowing very well that it's a very risky trade and a super bearish idea that you are long. If this holds, then you can continue holding. But the very moment you see this starting to break, and also keep in mind the 8% maximum loss on any position, I would suggest that you need to be a little bit on your toes on those two things. Either this is going to trigger your sell for a loss, or this break of this line is going to trigger a sell based on the visual analysis. Either way, the stock is super bearish in my opinion. And if we take a look at the hourly, you can see the hourly here is already, I believe today, made fresh lows. So there again, you're seeing what I'm talking about. It made fresh lows today, and more than likely, based on the way the market trades, if this breaks this line of support on the hourly, if this line breaks, more than likely that's another indication on the hourly that the instrument is due for lower prices. So to me, a risk trade, should you be in the trade? Well, you can based on the daily. There's nothing wrong in owning the instrument based on the daily chart, but the problem is that even that daily is suspect because of the way the monthly closed, or at least the way the monthly has been trading the last couple of years. So this one, in my opinion, not sure you should have been long this one, and probably should be playing the upside. Eric Muathe with Muathe.com. Good luck, peace, and blessings.